Well, another piece of data that came out yesterday, the ISM manufacturing disappointing to the downside, another sign that the U.S. economy is beginning to slow down. How do you think this translates, if at all, to the Fed's decision-making?
Yeah, thank you very much, Joumanna. Good morning. I think it's not the only piece of data. If you remember, the GDP and the PCE data last week both showed weakness in the consumer. Not only that, the earnings reports from many consumer companies are showing that the consumer, especially on the lower end, is now dropping off. So I think we are heading for a dramatic slowdown. The headline data doesn't show it. The rich probably are getting richer because they have savings and they're being paid huge interest rates on their savings. So they continue to spend. But the bottom half, 50% of the population, probably has run out of its excess savings and is worse off compared to pre-COVID days.
So the first rate cut, I should say, is not priced in until November. You think they should go sooner. What are the implications for financial assets if rates stay higher for too long?
I think if rates stay higher for too long, the Fed is sowing the seeds for the next financial crisis. This financial crisis could be very deep. If they hold on cutting rates for too long, waiting for that 2% to be achieved, we could be pushing the economy into a deep recession. There could be cracks appearing in other areas as well. So at that stage, the Fed will be left with no option but to go for aggressive rate cuts and maybe quantitative easing once again.
Right. So that's the ultimate end game. But the credit backdrop is still so far pretty favorable. You look at credit spreads at extreme tights. Of course, that tells you about what the market is thinking about, the investment outlook.
Yes.
Default rates have been low. Delinquencies are beginning to go up, but still, there aren't a lot of signs beneath the surface that there's trouble brewing.
I think, again, it's hiding the fact that the lower-end companies, the small, medium enterprises, are already facing the brunt of high interest rates. You can see how the layoffs are increasing, especially in the permanent jobs. You can see the hiring intention for small businesses. That has dropped off. It is showing negative in the next 3 to 4 months. So I think it's, again, the top-end consumer, the top-end companies are hogging the limelight, pushing the numbers, making the headlines look good. But I think at the bottom end and inside, you lift the hood, it's not looking very good.
Okay, well, team hard landing for sure.
Yes.
Deepak, let me turn your attention to one of the other developments you've been watching overnight. A lot of volatility in the Nifty and these Indian assets responding to the elections as the results come through. What do you make of this negative price action we're seeing in the Nifty this morning, and what does that tell you about investors' expectations about what the BJP can do?
Yeah, I think the investors obviously expect BJP to come back to power. I think that is not in question. The question is how many seats can they gather? And they were looking at a super majority, a landslide. And that somehow doesn't seem to be in the initial vote counting that we are seeing right now. And that is why Nifty is reacting to it. It's very important for the ruling party to get that super majority for them to go for the next round of reforms. And I think the market supports it and market wants it. So if they don't see it, that's where I think we have a bit of a problem.